Did you know that the distributions that you take as a result of crowdfunding could be taxable even if the funds aren't used for a business? We are talking about all types of crowdfunding from Kickstarter to GoFundMe. This even means that if you are raising money on GoFundMe for needs such as a funeral, it could be taxable. Taxability does depend on the nature of the campaign, so today we're going to take a look at what's taxable and what's not taxable for federal tax purposes. Now, I'm not giving you tax or legal advice. I'm just giving you general information about the taxability of crowdfunding distributions. Please consult with your own tax, financial, or legal advisor for help with your specific situation. When you take a distribution from your crowdfunding campaign, you might receive a 1099 from the crowdfunding website or the payment processor. If you receive a 1099-K, the total distributions received will be in box 1. Just because you receive a 1099, it doesn't automatically mean that the distributions are taxable, though. In just a moment, I will get into when you have to pay federal taxes on distributions. For 2024, if your distributions exceed $5,000 and you had more than 200 transactions, you might receive a 1099. Eventually, the distribution amount will be lowered to $600, regardless of the number of transactions or donations. Right now, the IRS is just giving payment processors time to adjust their software and whatever else to be able to accommodate the lower limit. My guess is that the lower $600 threshold will probably be implemented in 2025. Please keep in mind that if you organize a crowdfunding campaign for someone else and you take the distributions and then hand it over to the gift receiver, you, as the organizer, might receive the 1099. You don't have to include these distributions in your taxable income, though. Now, if you receive a 1099 and don't believe that the distributions are taxable, you can include a statement on your tax return explaining why it hasn't been included in your income. You still may be contacted by the IRS asking you why you left it out, so you may have to explain to the IRS for a second time why you did not include the distributions in your income. As an alternative, you can include the 1099 income on your tax return and then include a deduction for the entire amount. If the distributions from your crowdfunding campaign are taxable and is for a business, you will include distributions in your business income, and you can use business expenses and startup costs to offset some or all of your distributions. If you are an individual, you would include distributions on Schedule 1 of your 1040 federal tax return. Okay, let's get into when crowdfunding distributions are taxable. First, if you're crowdfunding for a business and you give equity in the company in exchange for a contribution, that's a securities transaction. So in this case, distributions from the crowdfunding campaign are not business income and are not taxable. For all other crowdfunding, as long as the donors do not receive or expect to receive any goods or services when they contribute, then the distribution may not be taxable. So please avoid giving t-shirts or anything else to donors, even something as simple as bumper stickers. If you give people something in return for donating, the IRS views it as a sale. This applies to both businesses and individuals. It really comes down to the facts and circumstances and whether the contributions are gifts. Most of the time, if it's a gift, you do not have to include distributions from crowdfunding in your income. If you are a business, you should check with your tax advisor to make sure that the contributions are indeed gifts. One thing that might surprise you is if your employer contributes to your campaign, it's includable in your income. It's never a gift. For instance, if you or someone else sets up a GoFundMe for your benefit and your company makes a contribution, you will have to include the contribution in income no matter what. This also applies to independent contractors and anyone in a work-for-hire situation. If you are not a 501c3 organization, please be sure to tell your donors that if they donate to your crowdfunding campaign, they can't take a federal tax deduction for it. Taxpayers can only take a tax deduction for a qualified 501c3 tax-exempt organization. You should also let them know that if they donate more than $18,000 or $36,000 if they are married filing jointly, they may have to file a federal gift tax return. These are the amounts for 2024, so please check each year for the current amounts. Even if the contributions weren't made to a 501c3, both the crowdfunding organizer and the person receiving the gift should keep good records. This includes keeping track of all distributions and documenting the names of donors and the amounts that they gave. You should keep these records for a minimum of 3 years. If you're raising money for someone else, it's best to have that person or business take the distributions directly. That way, you won't have to include distributions on your federal tax return. This also applies to getting audited by the IRS. If the IRS does an audit to examine how distributions were handled and you, as the organizer, took distributions, you would be involved in the audit too. By the way, if you want to know about some red flags that might trigger an audit of an individual, please watch the video in the upper left of your screen. If you want to know the top audit triggers for a small business, please watch the video on the lower right of your screen.